In this exercise, we will work through job order costing. Specifically, problem 328 in the book walks you through a very comprehensive example of a company who uses job order costing. Let's review for just a sec, though, before we start. First, if you recall a set of costs, call that set C. And the way we've partitioned this set up to this point is we have divided the manufacturing costs and we've distinguished those from the non-manufacturing costs. The manufacturing costs, direct materials, direct labor, and manufacturing overhead, and these are also known as product costs. These costs first become assets as they pass through the job order system. And then once the final products that these costs were historically incurred to produce, once those products are sold, then the costs, in a sense, the assets, since the assets that we sold expired or are gone, then the costs as assets have to expire and they're transferred to expenses. So these product costs are first assets in the form of inventory, raw materials inventory, work in process inventory, and finished goods inventory. And once the finished goods leave the shelf, once they're sold, then all the costs related to those goods that got those goods up to the point to be sold, which included costs for the raw materials, cost to convert them from raw materials to finished goods, so work in process stuff. And then these costs, once they leave the shelf, or once the goods leave the shelf, then the costs have to leave the shelf and they're converted over to expenses. These costs over here, the selling costs and the general and administrative costs, these costs are period expenses. They never become assets. They are expensed immediately in the period in which they are incurred. So it's critical to remember this idea about costs when we do job order costing. If you can keep this in your mind, that this left-hand side of the set C, these costs start out as assets and then they become expenses. And the right-hand side, just immediately, these types of costs are expensed. If you can keep that in mind, then it's easier to understand what's going on in these types of problems. So let's go ahead, let's erase everything I wrote here. And let's go ahead and work on this problem. So, this company designs and fabricates movie props. So 1 unit of their product would be a movie prop. We have a balance sheet for the company as of January 1st, which is the beginning of the current year. You can see the assets, the liabilities, and owner's equity stuff. It says because each prop is a unique design and may require anything from a few hours to a month or more to complete, Fantastic Props uses a job order costing system. Remember, companies which make products that are unique, where each unit is not identical to each of the other units, job order costing is the ideal way to accumulate or estimate costs for these sorts of companies. The idea is you just accumulate the costs by job, and then you take the total cost of the job and divide it by the number of units the job produced to get the per unit cost. The per unit cost is going to be different for each of the different types of products the company makes because they're unique. So for example, if we have a company, call it movie company A, they want to buy props for their movie that they're about to make. So they hire Fantastic Props. They want a particular prop though. So Fantastic Props makes that prop for them, and they probably want it in bulk. So maybe 1,000 of them. Fantastic Props will make the 1,000 props for movie company A, sell them to company A, and then calculate the per unit cost of making each of those props for company A by first accumulating the total costs for the company A's job and then dividing by the number of units that they produced, divided by 1,000. Movie company B might want a different type of prop and say they want 1,500 of those. To figure out the per unit cost for that type of prop, Fantastic Props will make all the 1,500 for company B, deliver those props to that company, accumulate those costs by company B job, then take the total cost of the company B job divided by the 1,500 of those props to figure out the per unit cost for that type of prop. So this is the idea behind job order costing. It says here that overhead in the fabrication shop is charged to props on the basis of direct labor cost. So the cost driver for overhead in this example is direct labor dollars. Dollars paid to your employees who directly work on the product. It says that their predetermined overhead rate for the year is based on a cost formula in which there's an estimated $80,000 in manufacturing overhead for the year, and they estimate to pay their people $100,000 in direct labor. Or $100,000. Their direct laborers are going to be paid $100,000. That's their estimate. So their predetermined overhead rate is 80 cents. For every dollar they pay their employees, they expect that to lead to an 80 cents increase in manufacturing overhead. And then we have a set of transactions that the company engages in during the year. So A through M. So what's required? First, we want to prepare a T account for each account on the company's balance sheet and enter the beginning balances. So that's the first thing. So for each of these accounts, we prepare a T account. So we can start with cash. And we can just do this for each account. Cash, accounts receivable. See what else? Inventories. We have our raw materials, work in process, and finished goods. So we'll need a T account for each of those. I'm just going to abbreviate. Actually, I want to keep these on the same row here. Raw materials, work in process, and finished goods. Oops, my line's not straight. There we go. Now I may need more room later, but if I need it, I'll extend the lines. Then we have prepaid insurance, and buildings and equipment, and then accumulated depreciation. I'll try to remain neat, although no promises. My writing does tend to get messy, especially if I start going fast. And then we have our accumulated depreciation. And what else? We have our accounts payable, and then capital stock and retained earnings. So we'll go ahead and record these. Capital stock I'll just abbreviate CS. And retained earnings I'll abbreviate RE. Alright. Now, let's see. Is that it? Yep. So that's part one. We've done part one. Next question. Make entries directly into the T accounts for the transactions A through M and then create new T accounts as needed. Determine an ending balance for each T account. So this was part 1. Now part 2 is we want to make entries in the T accounts for each of these transactions. Let's go on a separate page though and journalize the transactions so you can see what the journal entries would be. Well, you can see what the journal entries are if we just put, numbers into, like if we debit cash and credit accounts receivable, we could do something like that, and you would know exactly what the journal entry was. But let's actually write it out. And I've forgotten to put the beginning balances. I need to go ahead and put those in as well. Let's go back and put the beginning balances in. So cash was $15,000. If we look here, accounts receivable 40, and then 25, 30, 45, and so forth. Why am I putting on the left-hand side? Well, these are asset accounts. They have normal debit balances. The debit always represents the left side of the T account. Prepaid insurance was $5,000. Buildings and equipment had a beginning balance of $500,000. Accumulated depreciation. Accumulated depreciation is a contra asset. A contra asset has an opposite balance that an asset has. And since assets have a normal debit balance, accumulated depreciation would have a normal credit balance. Starts with $210,000. And then accounts payable is a liability, so it has a normal credit balance. Capital stock, or common stock, and retained earnings. In case you forgot from financial accounting, you can use this acronym to remember normal balance for a given account. Dealer. Dividends, expenses, and assets all have normal debit balances. And liabilities, owner's equity, and revenues all have normal credit balances. So that's what I'm using here. An account that has a normal debit balance, that means that it takes a debit to increase that account and a credit to decrease that account. And accounts which have normal credit balances, that means it takes a credit to increase that account and a debit to decrease that account. I know some of you are probably yawning right now because this is fundamental to financial accounting. But I think it's worth repeating or mentioning again. So now we want to journalize these transactions. So in part A, they bought some raw materials. So they bought wood, paints, and metal sheeting. They purchased the raw materials on account, which means they didn't pay cash for them. They put it on their tab. So there's a liability. So assets go up by $80,000. Raw materials inventory. And then accounts payable goes up by $80,000. The liability goes up as well. So that means we're going to debit raw materials inventory. Debit the asset to make it go up, and credit the liability to make it go up. For $80,000, and this is part A. Let's go record that. We debited raw materials for 80, part A, and we credited accounts payable for 80. And then part B. So this gets the raw materials into their storeroom, so to speak. Then in part B, they decide to take some of the raw materials out of the storeroom and issue them to production. For a total of $90,000 worth of raw materials were taken out of the storeroom and actually put into production, put into work in process. They start to take the materials and use labor and overhead to convert those raw materials to the finished product. Now, $5,000 of the $90,000 was for indirect materials, and $85,000 of the $90,000 was for direct materials. Indirect materials automatically are classified as manufacturing overhead. Manufacturing overhead includes all manufacturing costs that are not direct materials or direct labor. So by definition, indirect materials is a manufacturing cost, but it's not direct materials or direct labor, so it's manufacturing overhead. And an example of indirect materials would be like glue. Maybe they took 2 bottles of glue out of the storeroom. but they don't use all those 2 bottles of glue in the product. The 2 bottles of glue are worth $5,000, but in the actual product that they make, they only use, say, part of it. They use it as they need it. And so for each individual unit that they made, it's impossible to directly trace how much glue was used for that unit and then go figure out what it cost them to purchase that amount of glue. Because they didn't purchase that little tiny amount, they purchased it in a bottle. So you can see why it's called indirect materials. Now, the indirect portion would go into manufacturing overhead. The manufacturing overhead control account, we'll call it. And the direct portion would go into work in process. And it came out of raw materials inventory, so we got to reduce the asset account. Work in process inventory is an asset, it goes up. Raw materials inventory is an asset, it goes down. Manufacturing overhead control, that's a control account. You can think of it as an asset/expense account. Debits to the manufacturing overhead control account represent actual overhead, and credits to the manufacturing overhead control account represent estimated overhead. I need to go ahead and make this account since we don't have it yet. It's closed out at the end of every period, so it doesn't have a beginning balance. Its beginning balance is always 0. So we put 5,000 in. Anytime we have an actual incurrence of overhead, we're going to put it over here on the left-hand side as a debit. And then we're going to apply overhead over here on the right-hand side. Or we're going to estimate overhead. And we'll see that later. I'll talk about more about that here in a little bit. So we have to make a journal entry. So this is part B. And then WIP was debited for $85,000 in part B. And then we have raw materials inventory was decreased by $90,000 in part B. So hopefully you get the idea here. Part C. What's going on in part C? Payroll costs incurred and paid. Direct labor, indirect labor, and SG&A. So these are salaries and wages that have been incurred and they've already paid them. They already actually paid the people in cash. $120,000 were paid to those people who are directly working on the product. $30,000 were paid to those people who are indirectly working on the product. Those people that are in the factory, but they're not directly involved in making the product. So they're sweeping the floor, or they're performing janitorial services, or something like that. And then $75,000 were paid to people who aren't in the factory. They're salespeople trying to sell the product out in the field, or the CEO, some administrative person. So these costs are just period expenses. They're not even product costs. They're not manufacturing costs. So for the direct labor, that's got to go into WIP. For the indirect labor, that again goes into manufacturing overhead control. It's an indirect manufacturing cost. And then for the SG&A stuff, that's just an expense immediately. It doesn't become an asset. This cost doesn't become an asset. It's expensed immediately. These other costs, first are assets, and then they get expensed once the related products that those costs were incurred to make are sold. So WIP was 120, direct labor. And then they've already paid them, it said. They were incurred and paid, so we can just credit cash. Make assets go down, right? Make the cash go down. 120 and 30 is 150, and 75 would be 225. So there is another account here we've created that we don't have yet. Salaries expense, we'll go ahead and create that account. Set up that T account, and we've put $75,000 in it. It doesn't have a beginning balance. It's an expense account. It's an income statement account. All the income statement accounts are closed out at the end of every period. So that means, excuse me, excuse me. So that means they have a beginning balance of 0. So we can go put in the respective accounts 120 over here, corresponding to journal entry C, and then we put in the manufacturing overhead control account, we need to put 30, and then in the cash account, it looks like we need to put 225 as a credit. So let's go to the next one, D. Fabrication shop utilities cost, $12,000. This is money spent for utilities, so for the water bill and the electric bill, for the factory though. So these costs are indirect. It's hard to directly trace them to any individual unit that was produced in that factory. But since they're manufacturing costs, in other words, they were costs for the factory, incurring in the factory, then it's part of manufacturing overhead. So we put them in the manufacturing overhead. We can just credit. It says they were incurred. It didn't say they were paid. So that means we hadn't paid them yet. So we have a liability to pay them. I'll just put it into accounts payable. I'm not going to set up a separate liability account for each one of these things. I'm not going to set up utilities payable and all this. So we got $12,000 in manufacturing overhead control. And accounts payable has $12,000 extra added to it. Now let's look at part E. Ooh, I want to add an extra page here. So part E, it looks like we have some depreciation. So we record depreciation for the year, $30,000 total. $5,000 of this is for depreciation on selling and administrative assets. So depreciation on the CEO's printer, or depreciation on maybe the car that the salesperson drives around in to make sales calls. So that part is just an immediate expense. It's a non-manufacturing cost. It's on that right-hand side of the circle C. So it's immediately expensed. And then the $25,000 of this $30,000 depreciation is for depreciation on assets that are used actually in the plant. So depreciation on the air compressor, depreciation on all the machines, and so forth. So that depreciation it's an indirect cost. It's impossible to directly trace it to any of the individual products, but it is a manufacturing cost. So therefore it's manufacturing overhead. The other part is expensed immediately. We'll just call it depreciation expense. And the credit is to accumulated depreciation. So we have a new account that we don't have a T account for, so we're just going to go ahead and make that here. We're going to put 5,000 in it. And this is for part E. Remember, I messed that one up right there. Or I forgot that. All right, and then manufacturing overhead control, and then accumulated depreciation expense. And then where is manufacturing? Here it is. All right. So let's go to part F. I'm not going to make it through every one of these parts in this video. I'm going to have to stop this video and start a new one. So there'll be a part 1 and a part 2. But let's see if there's M parts. 1, 2, 3, 4, 5, 6. Yeah, I'll go through part G and then I'll stop the video and we'll do parts H through M on the next video. So here in part F we have prepaid insurance, which expires $4,800. So prepaid insurance is money that you spend in advance for insurance to cover a particular time period. Once the time period elapses, then the money you spend for insurance has expired. So prepaid insurance is an asset. Remember, the definition of an asset is some cost that represents a future economic benefit. And when you pay insurance in advance, it's a cost, it's money that you spent, but it represents in the future you're going to have the benefit of being insured over a given time period. Once that time period's over, then that asset expires and it becomes an expense. So the cost becomes an expense. Students typically are confused by the terms asset, cost, and expense. They just assume that costs are expenses. Not necessarily. Costs are first become assets, and then those costs become expenses once those assets expire. But certain costs obviously never become assets, and they're expensed immediately. And that circle that I drew earlier, that circle, we'll call that set of costs C. If we're in the left-hand side of that set, so we're in the manufacturing cost side, those costs become assets, then the assets expire, and the costs expire with them and become expenses. And on the right-hand side, those costs immediately are expensed. So I can't stress that enough. In understanding these concepts, you have to understand that. So we have $4,800 of prepaid insurance that has expired. $4,000 of this was paid for insurance on plant equipment, and $800 of this was paid for insurance on selling and administrative stuff. So insuring the car that the salesperson drives around and insuring some asset that's used in the selling and administrative capacity. That means that $800 of this is an expense immediately, and $4,000 of this is an asset. It's a manufacturing overhead because it's indirect and we can't directly trace it to any of the individual units of product. So we debit manufacturing overhead control for $4,000. We debit, we can call it insurance expense for $800, and then we credit prepaid insurance. Once the time has elapsed, then the prepaid insurance asset expires, and to make an asset go down, we got to credit it. So we need to set up one more account here we haven't set up yet, insurance expense. And now my writing is starting to get messy. I'll try to make it better here. And the manufacturing overhead control gets $4,000 put into it. Part F. And then prepaid insurance got $4,800 taken away from it. If we can find, here it is. Part F. So, and then let's do part G, and then we'll stop the video and we'll continue in the next video. Shipping expenses incurred, $40,000. Now, they weren't paid, they were just incurred. So that means we still have a liability to pay someone for them. Shipping expenses are part of the, if you think about the set of costs again, the right-hand side was the SG&A stuff. That's where shipping falls. In a job order costing system, shipping expense falls over here on this right side. It's a cost that's not incurred to get the units of product ready to be sold. It's after they're sold, getting the units to the customers. That's what shipping expense is, and so it falls over on this right side, and hence it's immediately expensed. So we'll debit shipping expense for $40,000, and we'll credit accounts payable. We incurred it, we hadn't paid it. So we have a liability, so we increased the liability. So we're going to create a new account here for shipping expense, which we didn't have. And then accounts payable we reduced by $40,000. And that takes us through part G. In In part 2 of this video, we'll go ahead and do parts H through M. We'll make the journal entries, and then we will finish we'll finish problem 2 here. We'll determine the ending balance in each of the T accounts. We'll do problem 3 and then problem 4. We'll figure out about the under or over applied overhead, and we will prepare an income statement. So that's it for this video.